The retail sector is experiencing devastation, with even well-established brands that have been around for centuries beginning to crumble due to the harshest economic climate since the 1970s. Numerous beloved stores will disappear this year, as retailers across the board face the consequences of falling sales, inflation, and heavy debt burdens during times of heightened financial uncertainty and increased risk of catastrophe. An array of companies across industries, from Starbucks to Disney and from clothing retailers to department stores, are teetering on the edge of collapse. Many are already experiencing mass closures as they struggle to adapt. In light of this, we've put together a list of companies that are battling for survival in 2023. Only the most resilient will endure, so watch this video to find out if your favorite brand is at risk of bankruptcy. Before we dive in, please show your support by giving us a thumbs up and subscribing to our channel. In this video, we'll be discussing 15 retailers that are collapsing before our very eyes. 1. Starbucks. Even the world's largest coffeehouse chain has not been immune to the accelerating retail carnage across the industry. After facing extensive shortages of key ingredients, packaging, and personnel, Starbucks decided to cut costs in order to weather the storm that's brewing in the sector. The company is now in the process of closing 500 locations, which means your local store could be next on the chopping block. 2. Disney. Disney's retail stores, which sell clothing, toys, and other merchandise inspired by their famous films, are struggling with their lowest sales in a decade, as reported by Yahoo. As a result, the company plans to close an additional 53 locations this year, following the closure of 60 stores in 2022. The entertainment giant is cutting 7,000 jobs, reducing its workforce by 15% as its brick-and-mortar operations underperform. Disney is now focusing on expanding its online presence to maintain sales of its products. 3. H&M. The global clothing retailer is still reeling from pandemic losses and is closing hundreds of stores and cutting thousands of jobs. In January 2023, H&M announced that it would permanently shut down 320 locations this year, a greater number than initially planned in November 2022. As a result, over 1,500 positions will be affected, with profits taking a bigger hit than expected and expenses beginning to take their toll, as reported by CNBC. 4. 99-cents only stores. The discount chain has already restructured its debt multiple times out of court, but it has been unable to resolve its underlying financial problems. Persistent inflation and high operational costs continue to exacerbate these issues. With over 350 locations in 4 states, consumer demand is steadily falling as people complain about increasing prices. Experts argue that 99-cents only stores are at a competitive disadvantage compared to larger retailers that have a more extensive network of suppliers and market leverage to maintain lower prices. The discount chain has also reported negative cash flow for 3 consecutive quarters, and its low ratings suggest more trouble lies ahead. 5. Estée Lauder. The beauty retailer, which operates brands like Bobbi Brown, La Mer, Clinique, MAC Cosmetics, Origins, and more, has experienced a 32% decline in sales in the last quarter of 2022. Estée Lauder is now permanently closing 15% of its retail stores and several department store counters to minimize its market exposure. Over 2,000 jobs will be eliminated during this process, and the outlook for 2023 remains bleak. The company anticipates sales to decline between 12% in the first quarter of 2023 due to decreasing demand, and revenue could also drop by 15%, causing its shares to fall by 53 cents in just 1 week. 6. Tops. This supermarket company, with approximately 180 Tops-friendly Markets locations in New York, Vermont, Massachusetts, and Pennsylvania, is at serious risk of vanishing from the U.S. economic landscape. According to the Wall Street Journal, the already bankrupt regional grocery chain carries a heavy debt load and is paying $375 million in dividends, making its business unprofitable and unsustainable. To date, no potential buyers have expressed interest in acquiring the indebted company, leading experts in the sector to believe that Tops is being left to fail. 7. Joann. The crafting retailer's balance sheet has appeared increasingly messy over the past few years. During lockdowns, the company saw a boom in sales as more people took up hobbies like sewing and knitting. However, after the economy reopened, JOANN struggled to maintain its momentum. In the last quarter of 2022, net sales declined by 6.8% compared to the same period the previous year, amounting to $463.3 million. JOANN's gross profit also decreased by 20% during that period, and its debt rose to $21.5 million. The company's outlook for 2023 remains grim, as it recently announced plans to close several stores and lay off hundreds of workers in an attempt to reduce costs and save the business. 8. Sears. The decline of Sears has been a drawn-out process over many years. The retailer has been continuously closing stores since it filed for bankruptcy in 2018, but 2023 may be the year the once popular department store closes its doors for good. The company has attempted to generate income and diversify its revenue streams by selling off parts of itself. However, these efforts have been largely unsuccessful, as the company remains unprofitable. Peter Vadi, retail expert and CEO of Market Gap Pro, noted in an interview with Best Life that the company has not posted a full-year profit since 2011, which suggests that 2023 could be the year Sears finally goes extinct. 9. Belk. The North Carolina-based department store chain, which operates in 16 states, reappeared on Moody's bankruptcy watch list in January after making the list in 2021. In 2023, experts predict that department stores and apparel brands will be particularly vulnerable to shifts in consumer demand and will be hard hit by the impact of inflation on disposable income spending. Many companies in the apparel and department store space are at risk of decline as discounts increase and consumers spend more cautiously, putting retailers like Belk in a precarious position, as highlighted by Moody's analysts. 10. Christopher & Banks. This women's apparel retailer, founded in 1956, first filed for bankruptcy in 2021 and began conducting out-of-business sales with discounts ranging from 40% to 60% across hundreds of locations. Christopher & Banks president and CEO Carrie Jones stated that the company sought protection due to the financial distress resulting from the pandemic and its ongoing impact. Currently, over 400 stores are closing across America as Christopher & Banks bid farewell to their loyal customers. 11. Kohl's. The once prominent department store has faced significant challenges in recent years. Originally founded in 1946 as a supermarket chain, Kohl's underwent a transition to become a department store as the industry evolved. However, department stores have been among the hardest hit by the retail apocalypse, forcing Kohl's to leave the sector in 2022 and restructure its operations to focus on retail fitness, athleisure, and denim clothing. Despite these efforts, insider data reveals that Kohl's retail sales have been declining for the past 7 months. The company's thin profit margins, combined with a nationwide decrease in discretionary spending, are financially devastating Kohl's, landing it on Moody's Analytics bankruptcy watch list for 2023. 12. David's Bridal. Often referred to as the Walmart of weddings, the bridal retail chain recently filed for bankruptcy and announced plans to lay off 82% of its staff, approximately 9,200 workers. The company had been struggling for several months before seeking Chapter 11 protection, marking its second bankruptcy in just 5 years. CEO James Malcolm revealed that if a buyer is not found soon, all stores may close by the end of the year, causing concern for brides-to-be across the country. 13. Clark's. The iconic shoe retailer recently underwent a buyout to improve its financial situation. A Chinese company acquired the 200-year-old UK footwear brand, which operates in the US and Europe. However, the change in ownership has led the company to close 25% of its stores in America, resulting in almost 2,000 job losses. Additional job cuts may be on the horizon as the company navigates a challenging restructuring process. 14. Furniture Factory Outlet. The home goods retailer, primarily based in the central United States, filed for Chapter 11 during the pandemic and was acquired by American Freight. Despite this, the company's situation hasn't improved. Slower discretionary spending and a growing debt burden have forced Furniture Factory Outlet to close over 40 stores and rebrand more than 30 locations in an effort to boost sales and stay afloat. 15. Guess, in the past decade, the retail jeans specialist has struggled to find a path to long-term success in the U.S. In the last quarter, the company reported a net loss of $2.9 million due to supply chain issues, rising transportation costs, and depressed demand, even during the holiday season. Currently, Guess is closing 100 locations across the country, and recent controversies surrounding copyright issues may further damage its sales outlook. High-profile artists like Banksy have spoken out against the brand on social media, fueling public outrage. The future of brick-and-mortar retail is being jeopardized by an array of challenges that continue to accumulate. As we enter another economic downturn, these retailers must demonstrate their relevance in a world where e-commerce is on the rise and find ways to draw customers back into stores amidst a trend of decreased spending due to the skyrocketing cost of living. If these retailers are unable to boost their revenue, manage their debts, and differentiate themselves from emerging brands, they could disappear sooner than expected. We want to hear about your experiences with these retailers. Share your thoughts in the comments below, and we look forward to seeing you in our next video. Thank you for watching.